So, picture your living room for a second. You're sitting on the couch, you grab the remote, and you hit that dedicated button with the little red N.
Oh, yeah. We all know it.
Right. You know exactly the sound that comes next, that iconic ta-dum. I mean, for over a decade, that sound has basically been the background score to our
He
lives.
really has.
It signaled the start of like a pandemic binge watch or a lazy Sunday or just a Friday night in. But behind that incredibly familiar interface, behind all the endless rows of true crime documentaries and stand-up specials, the company we all know so intimately has secretly undergone this radical financial
A
metamorphosis.
total 180, honestly.
Exactly. Like, think back just a few years. Remember when Netflix was the ultimate Silicon Valley poster child for, growth at all costs?
Burning cash like it was going out of style.
Literally burning billions of dollars on content. They were borrowing massive piles of money on the junk bond market just to survive, and constantly asking Wall Street for patience.
It felt like they were building this massive empire entirely on credit cards.
It really did. Well, check your calendars because it is currently April 16th, 2026, and the story has completely flipped. Netflix is no longer a cash-burning startup. It has transformed into an absolute cash-generating machine.
And, the transition from a company that relied entirely on external capital just to keep the lights on into this self-funding, incredibly profitable enterprise, it is arguably the most fascinating corporate evolution we've seen in modern media history.
Right.
I mean, we are looking at a complete inversion of their financial DNA here,
Mhm.
and the scale at which this transformation has happened is just unprecedented.
And unpacking that DNA is essentially the mission of today's deep dive. We have a massive stack of sources today, specifically two comprehensive AI-generated intelligence reports.
Heavy reading.
Oh, very heavy. One is titled Deep Value Intelligence, and the other is the Netflix Financial Research and Analysis Report. So we're going to look completely under the hood of Netflix to see exactly how they pulled off this pivot.
Because the mechanics of how a company stops burning billions and starts printing them is a wild ride.
It really is. And perhaps more importantly for you, the listener, we're going to figure out if this newly transformed company is actually worth its current price tag on the open market. Because the valuation math is, frankly, all over the place.
Oh, it's a mess right now.
Totally. Now, to figure out if that price tag is justified, we really have to look past the cultural hype and use some institutional-grade tools. Speaking of which, to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Getting the housekeeping out of the way, I like it.
Exactly. Okay, so with that out of the way, let's set the table here, because when we say we are looking at Netflix as a value investment today, I have to admit that feels entirely counterintuitive to anyone who has watched the stock market over the last 10 years.
Oh, absolutely. Evaluating a cultural behemoth like Netflix from a strict value investing perspective, it requires this deliberate act of cognitive dissonance, really.
Yeah, explain that.
Well, everyone listening to this has an opinion on Netflix, right?
Yeah.
You might love their interface, you might hate their recent price hike, or you might be, permanently furious that they canceled your favorite sci-fi show after one season on a cliffhanger.
Oh, don't even get me started on the cancellation.
Exactly. But a value investor has to strip all of that subjective emotion away. We have to completely separate the product we consume on a Friday night from the underlying financial engine that powers it.
So the product doesn't matter.
I mean, the question isn't whether their shows are objectively good art. The question is purely about business quality, the margin of safety in the stock price, and the cold, hard predictability of their future cash flows.
I want to lean into that idea of checking our emotions at the door. Because if we are going to talk about corporate drama and Wall Street emotions, we really have to start with the absolute phantom menace that was hanging over this company's head until very recently.
Ah, yes, the deal that wasn't.
Right. I'm talking about the massive $82.7 billion acquisition of Warner Bros. Discovery assets that, well, just abruptly didn't happen.
That aborted mega merger. Honestly, that single event almost completely reshaped the entire global entertainment landscape.
Let's remind people what was at stake there.
Right, so Warner Bros. Discovery controls HBO, the entire Batman IP, Harry Potter CNN, and this massive century-old legacy studio lot.
It is wild to think about the implications of that. Like Netflix, the ultimate Silicon Valley tech disruptor, was poised to swallow a massive chunk of legacy Hollywood in an $82.7 billion deal. They were going to own the Iron Throne, literally.
They really were.
But then, at the 11th hour, they just walked away. They spiked the deal. And the crazy part is they didn't just walk away empty-handed. They walked away with a $2.8 billion termination fee.
Which, and we need some serious context to appreciate this, a $2.8 billion breakup fee is a staggering sum of money just for a deal falling through.
It's like winning the lottery because you decided not to buy a house.
Exactly. To put that into perspective, there are hundreds of publicly traded companies in the Russell 2000 index that do not generate that much total revenue in an entire decade. And Netflix received it, essentially as a contractual apology for the deal not crossing the finish line.
Unbelievable.
Now, the market's initial reaction to a collapsed deal of this magnitude is usually just sheer panic.
Right. I would assume investors would freak out thinking, well, if they aren't buying Warner Bros., what on earth is the backup plan for growth?
That's the logical leap. But looking under the surface, pulling the plug was actually a massive flex of operational strength.
Okay, wait. Why was walking away a flex? Because normally an $80 billion growth strategy suddenly evaporating leaves this massive, terrifying vacuum.
Well, M&A at that massive scale is notoriously destructive to shareholder value. It is incredibly difficult to execute properly. You are suddenly dealing with violently clashing corporate cultures.
Like Silicon Valley versus old Hollywood.
Exactly. Fast-moving software engineers colliding with unionized legacy Hollywood studio executives. You have redundant workforces that need to be trimmed, which completely destroys company morale.
And the government gets involved too.
Oh, absolutely. You have massive multi-year regulatory hurdles with the FTC and European regulators scrutinizing every single move for monopoly violations.
Yeah.
By taking that $2.8 billion cash infusion and pivoting back to aggressive organic growth of their own platform, Netflix signaled to the market that their core engine was strong enough on its own.
They didn't need the crutch.
Exactly. They essentially told Wall Street, we don't actually need the Warner Bros. Catalog to survive the streaming wars. We are perfectly fine competing against it.
Wow. And the numbers from the very next quarter seem to absolutely vindicate that arrogance. Let's look at the Q1 2026 earnings because the numbers here are just a total blowout.
They really crushed it.
We are talking $12.25 billion in revenue for a single quarter, which beat Wall Street's estimates of $12.18 billion. So that is a solid revenue beat. But the real jaw-dropper, the number that had analysts genuinely doing double takes, was the earnings per share, the EPS.
Yeah, that was a stunner.
The street was projecting an EPS of 79 cents. Netflix came in at $1.23.
That is a 55.7% positive surprise.
Like, missing an estimate by 55% is usually a fireable offense for a CEO, but beating it by 55% at this massive multi-billion-dollar scale is almost suspicious. Mathematically, how does a company of this size suddenly find an extra 55% of profit in the couch cushions in just 3 months?
It comes down to a concept called operating leverage. That $1.23 EPS isn't like an accounting error or a one-off tax benefit. It is the mathematical proof of their lean cost structure finally reaching critical mass.
Break that down for us.
Sure. When a company has extremely high fixed costs, like spending billions on servers and filming content, and relatively low variable costs for adding new user, something magic happens. Every additional dollar of revenue after they cross their break-even point flows almost entirely to the bottom line as pure profit.
Because it doesn't cost them anything extra for one more person to hit play.
Exactly. What we saw in Q1 was extreme efficiency in how they convert their content spending into actual bottom-line revenue. They are wringing more viewing hours, higher subscriber retention, and incredibly lucrative ad dollars out of every single dollar they spend on production.
Okay, so let me just get this straight in my head. They walk away from a distracting, bureaucratic merger nightmare. They pocket almost $3 billion in pure cash just for signing a piece of paper. And then they immediately proceed to beat profit expectations by nearly 60%. I would assume the stock absolutely went to the moon the next morning, right?
You'd think so, but the market mechanics tell a much more nuanced story. Despite that massive EPS beat, the stock actually dipped slightly.
Wait, it dipped?
Yeah, it went down 0.32% in aftermarket trading, closing at $107.37.
That makes zero intuitive sense to me. They crush earnings, they have billions in new cash sitting there, and the stock goes down. Help me understand the psychology of the institutional trader here.
Wall Street is a forward-looking discounting mechanism. They do not care about what you did yesterday. They only care about what you will do tomorrow.
So the Q1 beat was basically old news to them.
Basically, yeah. The market wasn't reacting to the amazing Q1 performance because they had already priced a lot of that in. They were reacting to the forecast for Q2, which Netflix management intentionally kept very conservative.
Sandbagging the next quarter.
Precisely. Furthermore, that $2.8 billion termination fee actually created a brand new problem.
Uncertainty.
Uncertainty, it's cash. True. But Wall Street hates a question mark, even a very wealthy one. Investors are demanding to know the capital allocation plan. Is Netflix going to issue a special one-time dividend? Are they going to aggressively buy back their own shares to boost the stock price? Or are they going to take that $3 billion and blow it on some new, highly risky, unproven venture?
So they're worried they'll waste it.
Exactly. That specific uncertainty spooked the short-term algorithmic traders.
I get it. It's like a sports team that almost trades for a highly expensive superstar, right? The deal falls through, but the team gets a pile of first-round draft picks as an apology from the league.
That's a great way to look at it.
Right, and then they go out and win the championship with their current roster anyway. But the fans and the sports radio hosts are still incredibly nervous about next season. They are sitting there complaining, yeah, we won, but what is the general manager going to do with all those draft picks? Are they going to draft a total bust?
Spot on. The team proved their current roster is championship caliber, but the anxiety over future resource allocation completely overrides the celebration of the current victory. However, if we zoom out from the short-term noise of that aftermarket dip, the underlying truth is that this Q1 performance is not a fluke.
Not at all.
It is the culmination of a massive, decade-long shift in how Netflix operates financially.
Which transitions us perfectly into the real meat of this analysis, I think. The complete and total end of the cash burn era. Because for years, if you asked a traditional value investor, someone who rigidly follows the Warren Buffett philosophy of analyzing intrinsic value and cash flow, what they thought of Netflix stock, they would have probably laughed you right out of the room.
Oh, they would have actively shorted it. No question.
Really?
Yeah. A decade ago, Netflix was the absolute antithesis of a Buffett stock. It was a capital-hungry monster. To fuel their global subscriber land grab, they had to spend billions of dollars on producing original content years before anyone had ever watched it or paid a monthly fee for it.
Just massive upfront costs.
Right. And to bridge that massive gap between spending cash today and collecting subscription revenue tomorrow, they were taking on massive loads of high-yield corporate debt. Their free cash flow was consistently and aggressively negative. They were literally burning billions of dollars a year in cash just to keep the cameras rolling on the sets of their original series.
I vividly remember reading headlines around 2018 and 2019 about them being $3 billion in the red on cash flow, taking on junk bonds at terrible interest rates, and yet the stock just kept going up and up because the total number of subscribers was growing. It honestly felt like a magic trick or maybe a house of cards that was just waiting for a single interest rate hike to blow it over.
It was a highly precarious, very expensive growth phase. The thesis was always, we will spend whatever it takes to win the global monopoly on attention, and once we win, we will raise prices and turn off the spending spigot.
And did they?
Well, look at where we are today in 2026. The thesis actually played out. According to the Deep Value Intelligence report, their trailing 12 months free cash flow is now sitting at $9.46 billion.
Let me just repeat that so it sinks in for everyone. $9.46 billion in positive free cash flow.
Yep.
That's money left over after paying all the bills, the actors, the server costs, everything.
And their free cash flow margin is 20.9%.
You mean what? Exactly.
That means for every $100 that comes in the door, almost $21 falls straight to the bottom line as unencumbered cash. That margin is elite for any industry software, pharmaceuticals, anything. But for a media company saddled with massive physical production costs, it is staggering.
Wow.
This is the exact inflection point that value investors patiently watch for. It is the moment a capital-intensive, high-risk growth platform finally matures into a predictable, cash-generating utility.
We really need to talk about the profitability metrics detailed in the sources, because the numbers here are almost hard to believe for a streaming company. Return on equity, or ROE, is sitting at an immense 41.3%. And return on invested capital, ROIC, is 35.9%. Now, for the listener who might be, say, prepping for a board meeting and doesn't stare at balance sheets all day long, let's break this down. Why are those two specific numbers the holy grail for a value investor?
Return on invested capital, or ROIC, is arguably the single most important metric for determining the true quality of a business. It tells you exactly how efficient a company's management team is at turning capital into profit.
Give me an example.
So if you give Netflix $100 to invest in their business, whether they use it to buy more AWS server space, film a new season of a hit show, or run a marketing campaign in Europe, a 35.9% ROIC means they are generating nearly $36 of operating profit annually on that specific investment.
That's huge.
To put that in perspective, most legacy Hollywood media companies would be doing backflips to hit half of that number. It proves that their global scale gives them unprecedented operating leverage. They figured out how to make money on money better than almost anyone else in the sector.
And when you look at their balance sheet from the 2025 10K filing, it completely reflects this newfound financial health. Like, they reduced their total debt by $1.12 billion over the year. They're down to roughly $14.5 billion in total debt, which sure sounds like a massive number to a normal person until you realize they are currently sitting on a cash cushion of $9 billion.
Right. Their net debt, which is just total debt minus the cash they have on hand, is incredibly manageable. They have successfully transitioned from a high-yield junk bond credit profile that relied entirely on Wall Street's mercy into a self-funding investment-grade fortress.
And they're buying back a ton of stock.
Oh, massively. Because they have more cash than they know what to do with, they are returning capital to shareholders at a massive clip. In 2025 alone, they repurchased 86.5 million of their own shares for $9.1 billion.
Which just makes the remaining shares more valuable.
Exactly. Buying back stock reduces the total number of slices in the pie, making every remaining slice more valuable. They even executed a 10-for-1 forward stock split to make the nominal share price more psychologically accessible to retail investors. But to truly understand why these new profits are considered high quality today, we really have to spend some time on a very specific, somewhat dense accounting concept from the intelligence report.
Oh, I know what you're going to say.
Amortization convergence.
Yes. I saw this exact phrase in the notes, and it fascinated me. Amortization convergence. It honestly sounds like the title of a late-night sci-fi movie.
It does.
But it's actually an accounting reality that explains their massive profit surge. Break the mechanics of this down for us. What exactly is converging?
This is arguably the most critical metric for understanding Netflix's true underlying profitability, and it requires a quick lesson in corporate accounting. Historically, there was a massive disconnect between the cash Netflix spent to make shows and the expenses they actually reported on their income statement.
Okay, so when Netflix spends cash to produce a show, they don't expense all of that cash in the year they spend it.
Exactly.
They do not. Let's use a hypothetical to make this concrete for you listening.
Yeah.
Let's say Netflix greenlights a massive new sci-fi series. They write a check today for $100 million in cold, hard cash to pay the directors, the CGI artists, and the actors. What happens on the balance sheet?
They subtract $100 million from their cash pile, obviously, but they do not report a $100 million expense on their income statement for that specific year. Because that TV show will theoretically generate value and attract subscribers for several years to come, accounting rules dictate that they must amortize or spread out that expense over the useful life of the show.
Right, so they chunk it up.
Yeah, so they might only report $20 million of expense in year one, $40 million in year two, and so on.
Meaning they just spent $100 million in real cash, but they get to tell Wall Street their expenses were only $20 million, which artificially makes their profit look dramatically higher than their actual bank account would suggest.
Precisely. It made their accounting net income look much, much better than their actual cash reality. Now, it is a completely legal, necessary accounting practice for long-term assets, but critics and short sellers argued for years that this practice hid the true crushing cost of their content treadmill.
Because the bill comes due eventually.
Right. They argued Netflix was building up a massive delayed tidal wave of future expenses. But today, the intelligence sources note a monumental shift. Their annual cash content spend, which is hovering around $17 to $18 billion, and their recognized amortization expense on the income statement, which is around $15 to $16 billion, have finally converged.
Oh.
They have narrowed to a 1.1x ratio.
So the wave finally crashed. The cash going out the door and the expenses hitting the books are essentially matching up in real time now.
The gap is completely closed. The hidden ghost costs of their massive historical content library are now fully recognized in their current profit and loss statement. So when Netflix reports $11 billion in net income today, that is real, tangible, unencumbered profit. It's not just a clever accounting illusion masking a cash fire. It is real money.
But I have to stop you there and push back on this because the sheer scale of the numbers you just casually mentioned is terrifying.
They are big numbers.
You just said they're spending $18 billion a year in cash on content. $18 billion. dollars every single 12 months just to keep us from getting bored and canceling our subscriptions. That is more than the GDP of some small countries.
Easily.
So is this actually a great sustainable business model, or are they just running on a very, very expensive treadmill that they can never, ever step off? Because if they stop running, the content stops and we all cancel.
That is the single most important question you can ask about this company, and it goes to the absolute heart of the bear argument against Netflix. The content treadmill is very real, and it is exhausting. If they stop spending, the audience immediately leaves for a competitor. However, what the data in these reports shows us is that Netflix has successfully entered what financial analysts call the harvest phase.
The harvest phase. Explain the mechanics of that. I like the sound of it.
The harvest phase occurs when a company's top-line revenue begins growing significantly faster than its core operating costs. For the last 10 years, Netflix's content spending had to grow at 20% or 30% a year just to build a foundational library of shows to compete with legacy Hollywood.
Right. They were starting from 0 original shows.
Exactly. Now, that library is built. It exists.
Right.
They still need to spend a massive amount, that $18 billion, to refresh it with new hits, but they don't necessarily need to increase that budget to $25 billion or $30 billion.
But the ceiling is kind of set.
Right. If they can hold their content costs relatively flat at $18 billion and continue to grow their top-line revenue through price hikes and adding new tiers, every single incremental dollar of new revenue flows almost entirely to the bottom line. The heavy lifting of building the infrastructure is over. If management maintains strict cost discipline, the cash machine will only accelerate.
And to ensure that top-line revenue keeps growing faster than those massive fixed costs, Netflix realized they couldn't just rely on standard subscriber growth anymore. The North American market is essentially saturated, right? Everyone who wants a Netflix account already has one,
Pretty much.
which forced them to pull some new, highly controversial levers. Let's examine what is actually driving this harvest phase by looking at the 3 modern growth engines of Netflix. Engine number 1, the ad tier.
The advertising tier is a massive paradigm shift. It launched in late 2022, and the growth has been explosive. By November 2025, it had reached 190 million monthly active viewers globally on the Standard with Ads tier.
190 million people willingly watching commercial breaks on Netflix. If you told a media analyst in 2018 that Netflix would be running soap and car commercials, they would have called you crazy. I mean, the founder, Reed Hastings, famously, vehemently hated the idea of ads. He said it ruined the purity of the user experience.
Oh, he was a staunch opponent.
Yeah.
But the underlying economics of the streaming wars became completely undeniable. The ad tier solves 2 massive problems simultaneously. First, it significantly lowers the barrier to entry for highly price-sensitive consumers, particularly in developing global markets.
Right, it gives them a cheaper option.
Which drastically reduces subscriber churn when inflation bites into household budgets. Second, and more importantly for the bottom line, it opens up an entirely new, incredibly high-margin revenue stream. The reports project the ad tier alone will reach $3 billion in revenue by late 2026.
$3 billion just from ads.
Because Netflix has such precise data on viewing habits, they can charge premium CPMs cost per mil, or the cost per 1,000 views, to advertisers. This transforms Netflix from a pure-play subscription business into a highly lucrative hybrid model.
I want to talk about engine number 2 because this one hit a lot of our listeners right in the wallet, the password crackdown, also known as the Great Netflix Eviction.
In corporate speak, it is heavily referred to as paid sharing enforcement.
Huh. Whatever corporate jargon you want to use, it worked beautifully. I have to admit, I was one of those people. I got the email saying my device wasn't part of the primary household. I was furious. I swore I was going to cancel on principle.
But you didn't.
But I didn't. I paid for my own account. And judging by the intelligence report, I was far from the only one who caved. The reports note this crackdown was highly successful in converting shared free writing accounts into fully paying members. It was specifically highlighted as a massive growth driver in Latin America, which is fascinating given the economic volatility in that region.
The psychology of the consumer during this transition is truly fascinating. When Netflix first announced the crackdown, the stock market actually panicked. Analysts feared massive consumer backlash, boycotts, and a tidal wave of cancellations.
Which was a reasonable fear.
Very reasonable. But Netflix management had correctly calculated something profound. Their content had transitioned from a luxury add-on into a household utility. Much like your electricity or your internet bill, people complained bitterly about the price, but ultimately they paid it because the alternative, staring at a blank wall on a Tuesday night, was worse.
It's true.
It proved definitively their immense pricing power and the absolute stickiness of the platform. The fact that it succeeded in Latin America, a region highly sensitive to price fluctuations, really proves the utility theory.
So if you were listening right now and you were one of the millions of people who finally caved and bought your own account after getting kicked off your ex-roommates or your parents' Netflix, you need to realize that you are literally the reason their margins are expanding right now.
Yeah,
You personally funded the harvest phase.
you did.
But let's look at engine number 3, because this is the one that I believe completely changes the entire future landscape of the company, live sports. Specifically, the massive success of the 2026 World Baseball Classic in Japan.
The WBC in Japan was the ultimate, undeniable proof of concept for their live broadcasting infrastructure. Netflix secured the rights, broadcast the games live in Japan, and it hit 31.4 million concurrent viewers.
31.4 million.
It became their most watched program in the history of Japan, and it single-handedly drove the largest single day of new subscriber signups in the country's history.
31.4 million concurrent viewers for a live sporting event. Let's pause and appreciate the sheer technological hurdle of that. Netflix has spent its entire corporate life as an on-demand asynchronous platform. They store files on servers, and you download them when you want.
Which is relatively easy to scale.
Right. Live events require a completely different, highly volatile, incredibly expensive infrastructure. Millions of people logging on at the exact same millisecond. No buffering allowed. If the stream drops during the bottom of the ninth inning, the brand damage is catastrophic.
It is an immense technical challenge, and by proving they can handle it flawlessly at that massive scale, they just permanently altered their value proposition to advertisers. Advertisers will pay an absolute premium for live sporting events because the audience is entirely captive, highly engaged, and watching in real time.
Because you can't fast forward through a live commercial break.
Exactly. This completely alters the financial trajectory of their regional growth, specifically in the APAC or Asia-Pacific region.
Let's actually break down the math on those geographic regions because the balance of power within Netflix is shifting globally.
It really is. The US and Canada region, known as UCAN, is a mature, saturated market. It still generates the lion's share, about 44% of their total global revenue, and the average revenue per user, the ARPU, is exceptionally high at $17.26 per month.
But the growth is flat.
Right, the actual subscriber growth there has flattened out. The Asia-Pacific region, however, is the high-octane growth engine right now. The ARPU there is much lower, sitting around $7.34, but the sheer volume of new subscribers, driven by heavily localized hit shows and massive live events like the WBC, is fueling the company's global expansion. They're basically trading high margins in the US for massive volume in Asia.
And there's a specific statistic hidden in the research report that just absolutely blew my mind regarding their global efficiency. We talked earlier about their massive $18 billion content spend, but let's look at how they market that content. Netflix spends roughly $2.9 billion a year globally on marketing, which sounds like a massive number until you stop and realize they are spending almost $3 billion marketing a single solitary product, just Netflix.
It is an incredible point of contrast when you compare them to legacy media conglomerates. Think about the marketing budget of a company like Disney or Amazon.
They have to spread it everywhere.
Exactly. Disney has to fracture its marketing spend across theme parks, cruise lines, theatrical movie releases, physical merchandise, legacy cable networks like ESPN and Disney Plus came. Amazon has to market its retail delivery, AWS cloud services, Kindle hardware, and Prime Video. Netflix takes nearly $3 billion in cash and points a massive concentrated fire hose of marketing entirely at one single subscription service.
It creates an unmatched efficiency in global brand building and customer acquisition.
They are just relentlessly, ruthlessly focused.
So summarizing the bullish case here, Netflix is clearly firing on all cylinders. The transition from debt to cash flow is complete. The ad tier is printing money. The password crackdown forced millions to pay up. And live sports have opened a massive new frontier. But what happens if the track gets muddy?
Because it always does.
Because if you read deeper through the Deep Value Intelligence report, the expert value investors have some serious existential reservations. We need to look at the dark side of the moon. Let's examine the moat, the bears, and the Bill Ackman cautionary tale. Every single value investor looks for an economic moat. You know, a structural, almost unfair advantage that protects a company's profits from invading competitors. What exactly is Netflix's moat?
If you read the structural analysis in the reports, Netflix's moat is purely its massive global scale. It is the simple mathematical fact that they have over 325 million global paying
So
subscriber.
does that protect them?
As we discussed earlier with the harvest phase, content costs are fundamentally fixed. It costs the exact same $20 million to produce an episode of Stranger Things, whether 10 people watch it or 10 million people watch it. Because Netflix can take that fixed $20 million cost and amortize it or spread it out over 325 million paying accounts, their cost per subscriber is radically lower than anyone else's in the entire streaming industry.
Oh, I see.
They can outspend a competitor like Paramount on a show, but still pay less per user to make it.
Okay, I understand the math of the scale moat. But notice what you distinctly didn't say just now. You didn't say their moat is their intellectual property.
And that is a crucial, fundamental distinction that bears heavily on their valuation. Look at Disney. Disney possesses a true generational IP moat. Mickey Mouse, the Star Wars universe, Marvel superheroes, those are deeply durable cultural assets that consumers, particularly parents, will actively seek out and pay for, almost regardless of the platform they are on.
Netflix does not have that luxury.
No, they don't. If Netflix's algorithm stops producing new viral water cooler hits, their back catalog of older shows is simply not strong enough on its own to prevent subscribers from churning and moving to a competitor. Their moat is entirely built on distribution infrastructure and scale, not necessarily irreplaceable intellectual property.
Which makes the underlying business model inherently a bit more fragile than it appears on the surface. And that specific fragility brings us to one of the most fascinating case studies in recent Wall Street history. Let's talk about the infamous Bill Ackman trade.
Oh, Bill Ackman's hedge fund, Pershing Square. This is a legendary, almost painful story of a classic value investor colliding head-on with the volatile realities of the streaming industry.
Tell us what happened.
In early 2022, after a massive dip in Netflix's stock price, Ackman aggressively bought 3.1 million shares for roughly $1.1 billion. His public thesis was that he was drawn to their high-performance corporate culture, their dominant market share, and what he believed was a highly predictable subscription revenue model.
So $1 billion bet from one of the smartest guys in the room. And what happened?
Exactly 3 months later, he aggressively sold the entire position. He completely liquidated it. He walked away with a $430 million realized loss.
Wait, 3 months. He lost almost $500 million of his clients' money in 90 days. Why did he panic? I mean, a value investor is supposed to hold for years, not weeks.
Well, it wasn't a panic born of emotion. It was a cold, calculated reevaluation of the fundamental predictability of the business model. You see, right after he bought his billion-dollar stake, Netflix management announced that they were going to fundamentally alter the business by introducing the advertising-supported tier to combat slowing growth.
Right, which we just said was a good idea.
Strategically, as we discussed, launching ads was a brilliant, necessary move for the company's long-term survival. But from a strict value investing perspective, it completely destroyed the math Ackman relied on. Value investing demands absolute certainty. To value a company, you need to be able to reasonably project its cash flows 5 or 10 years into the future.
Ads messed that up.
Ackman realized that shifting from a pure, highly predictable monthly subscription model into a volatile advertising model introduced a massive slew of new variables: fluctuating ad rates, cyclical corporate ad spending, entirely new subscriber churn dynamics that made those future cash flows completely unpredictable.
I think I understand his logic. It sounds like Ackman looked at Netflix pivoting to ads like a beloved, highly profitable local restaurant suddenly deciding to change its entire menu from Italian to sushi.
That's a good way to put it.
Like, even if the new sushi menu might attract a much bigger crowd eventually, you can't guarantee that the old, loyal regulars will stick around through the awkward transition phase. You can't accurately predict the cash register receipts anymore. So rather than gamble on the unknown, he just accepted the massive loss, took his chips, and walked away from the table entirely.
That is an excellent analogy. If you cannot reliably predict the cash flows, you cannot calculate the intrinsic value. And if you cannot calculate the intrinsic value, you simply should not own the stock as a disciplined value investor.
Yeah.
He stuck to his principles, even though it cost him $430 million to do so. And the bears today point to several other highly unpredictable risks that could threaten that cash flow model beyond just advertising volatility.
Right. Let's look at those specific current risks outlined in the reports. First, the overall competition for human attention is becoming brutal. They aren't just fighting traditional streaming rivals like Disney Plus and Hulu anymore.
Not at all.
They are engaged in an all-out war with YouTube, TikTok, and immersive video gaming. Every single minute a teenager spends mindlessly scrolling TikTok or playing Roblox is a minute they aren't watching Netflix, which lowers their perceived utility.
Which leads to churn.
Exactly. Then there are the massive regulatory risks. The European Union is now actively forcing catalog quotas, meaning Netflix is legally mandated to produce a certain high percentage of local content in European countries, which severely messes with their global efficiency model. And they are currently fighting a massive, complex $600 million tax dispute in Brazil.
The global regulatory landscape is becoming incredibly hostile. As Netflix transitions from a novel tech company into a dominant, ubiquitous global utility, sovereign nations are demanding their cut, either through aggressive taxation or through forced financial investment in their local film and television industries. It creates massive friction on their profit margins.
But I want to take a moment to extrapolate on something the intelligence report only briefly touches on, but feels like a massive looming iceberg. Generative AI.
Ah, yes. The big unknown.
How does Gen AI actually threaten Netflix? Because my initial thought is, great, AI will make their CGI cheaper, their script writing faster, and their massive production costs will plummet. But isn't there a severe dark side to this technology for them?
There's a massive structural threat that goes far beyond just lowering their internal operating costs. The true existential threat of generative AI is the absolute democratization of content
I
creation.
mean, anyone can do it.
Exactly. If generative AI progresses to the point where an independent 19-year-old creator sitting in their garage can produce a cinematic, high-quality, photorealistic show for practically zero cost and upload it directly to YouTube or a decentralized platform, it completely destroys the historical barrier to entry in Hollywood.
And Netflix's moat relies on that barrier.
Precisely. Netflix's entire economic model relies on the fundamental fact that making premium TV is prohibitively expensive for everyone except a few massive, heavily capitalized studios. If AI makes premium blockbuster content incredibly cheap and ubiquitous, the inherent value of a $17 a month Netflix subscription drops dramatically because the global supply of high-quality entertainment suddenly becomes infinite.
So the fear is that anyone with a laptop and an internet connection becomes a rival movie studio. That is a terrifying prospect for a company currently committed to spending $18 billion a year on traditional human-led production.
It's the ultimate disruption.
With all of these highly unpredictable risks swirling around, the Ackman cautionary tale regarding unpredictable cash flows, the tic-tac war for attention, the regulatory crackdowns, and the looming existential threat of AI, we have to finally ask the ultimate value investing question. What is this incredibly complex company actually worth today?
Let's do the math.
Let's dive deep into the valuation dilemma: price versus intrinsic value. Let's look at the hard numbers as of April 2026. The current share price on the open market is roughly $108. The PE ratio, the price-to-earnings ratio, is 42.6.
A price-to-earnings ratio of 72.6 is objectively steep for a mature company. It means that investors buying the stock today are willing to pay almost $43 up front for every $1 of current annual earnings the company generates. You are paying a massive premium for expected future growth.
And the deep value intelligence sources provide a really wide, almost confusing range of intrinsic value estimates. This is where the math gets incredibly messy for a retail investor. On the extreme bearish end, using a strict no-growth model, the intrinsic value is pegged at a dismal $23.43 a share. On the extreme bullish, optimistic end, it's modeled at $229 a share. The classic Buffett method, which uses owner earnings, estimates it at $126.06. And a standard discounted cash flow, or DCF model, puts it right around the $99 to $106.
This massive spread in valuation from $23 to $229 is precisely what scared Bill Ackman away. When highly paid professional financial analysts look at the exact same historical financial data, the exact same balance sheet, and come up with intrinsic values that are literally hundreds of dollars apart, it tells you one critical thing. The future is highly, highly uncertain.
Because it's all based on guesses.
The output of these models depends entirely on what specific subjective assumptions the analyst plugs into the spreadsheet regarding terminal growth rates, long-term margin expansion, and the ultimate success of the ad tier.
Let's actually break down the mechanics of these models so the listener isn't just hearing jargon. Let's start with the standard discounted cash flow model, the DCF, which came in around $100. For someone driving in their car right now, what is the actual mechanism of a DCF? How does it work?
A discounted cash flow model is based on a very simple, fundamental principle of finance: the time value of money. A dollar in your hand today is worth more than a dollar promised to you tomorrow, because you could take today's dollar, invest it, and earn interest on it.
Makes sense.
Therefore, to value a company like Netflix, an analyst has to project exactly how much cash the company will generate every single year for the next, say, 10 years. But because that cash is in the future, it is worth less today. So the analyst discounts those future cash flows back to their present value using a specific discount rate, which factors in inflation, interest rates, and the inherent risk of the business.
That's complicated.
You add up all those discounted future cash flows, divide by the number of shares, and you get the intrinsic value. The problem is, if you slightly tweak your assumption about how much cash they will make in year 8, it drastically changes the present value today.
And what about the Buffett method? The report mentions it uses something called owner earnings to arrive at the $126.66 valuation. What exactly are owner earnings?
Owner earnings is Warren Buffett's preferred metric because it seeks to find the true distributable cash a business generates. You take the reported net income, you add back the non-cash accounting charges like depreciation and amortization, but then, and this is the crucial step, you subtract the essential capital expenditures.
CapEx.
Right. CapEx is the money a company must spend on physical assets just to maintain its current competitive position, like buying new servers or upgrading office buildings. Buffett loves companies with high net income, but very low CapEx, because they don't have to constantly reinvest their own profits just to tread water.
And Netflix fits that.
Netflix's owner earnings look incredibly strong right now because despite their massive content spending, their traditional CapEx is relatively low compared to a company building physical factories.
Let's talk about the growth expectations baked into the current price. Revenue growth is currently sitting at 15.9%, but that leads to a PEG ratio, the price earnings to growth ratio of 2.68. What does a PEG of 2.68 actually mean in plain English for an investor?
The PEG ratio is a way to contextualize the PE ratio by factoring in how fast the company is actually growing. Generally speaking, a PEG ratio of 1.0 suggests a stock is fairly valued relative to its earnings growth rate.
So 2.68 is bad.
A PEG of 2.68 is a massive red flag for a value investor. It mathematically indicates that the stock's price is rising much, much faster than its actual underlying earnings growth. It means the market is already pricing in the absolute perfection of the ad strategy, the flawless execution of the live sports rollout, and zero missteps by management.
So no room for error.
Exactly. You aren't paying for the highly profitable Netflix that exists today. You are paying a hefty premium for a flawless theoretical execution of what they hope to be in 3 to 5 years.
Okay, if the intrinsic value math is literally all over the map, ranging from $23 to $229 depending on who is building the spreadsheet, how are you, the listener, supposed to logically make sense of a $188 price tag? Are we basically just blindly paying a premium for a perfect future that hasn't happened yet?
That is the ultimate dilemma. The intelligence reports use a very helpful conceptual framework called the valuation bridge to visualize why these numbers differ so wildly.
How does the bridge work?
If one specific valuation method, like that incredibly optimistic $229 bull case, is vastly higher than the standard DCF model of $100, it means that high valuation relies on a very fragile bridge of strict optimistic assumptions. It assumes that their profit margins will continually and smoothly expand to 30% or more, that global ad revenue will scale massively without cannibalizing their core subscription base, and that those massive content costs won't unexpectedly spike due to a Hollywood strike or inflation.
And if they do?
If even one single plank on that bridge cracks, if ad growth slows down just a little, the entire intrinsic value plummets. However, when multiple different valuation methods cluster tightly together, like how the DCF model and the current market price are hovering right around that 108-day market, strongly suggests the $100 level is a much more robust, reality-based baseline.
But there's a catch.
There is. Crucially for our audience, buying exactly at that baseline leaves almost zero margin of safety for the investor if things go wrong.
So, if the underlying fundamentals of the business are undeniably solid, they have the massive cash flow, they have the expanding margins, they beat earnings, but the valuation is a bit too rich, priced for absolute perfection, and leaves no margin of safety. What are the actual day-to-day traders doing right now? Let's transition to market mechanics, sentiment, and the final stance. Let's look at the technical charts.
The charts are fascinating right now.
The technical analysis in the report shows Netflix stock bottomed out around $75 in February 2026. Since then, it has rebounded hard, breaking sharply above the 50-day moving average. And right now, as we record this, it is currently testing a massive long-term psychological resistance level at the 200-day moving average, which is sitting right around that $106 to $108 mark.
For the layperson who doesn't stare at stock charts, moving averages are simply mathematical ways to smooth out chaotic daily price data to see the real underlying trend. The 200-day moving average is closely watched by institutional algorithms. Approaching the 200-day moving average from below is a critical technical inflection point. It acts as a massive gravitational pull or a point of heavy resistance.
I always think of moving averages like a giant rubber band attached to the core price of the stock. If the price drops way below the 200-day average down to $75, the rubber band is stretched thin and eventually it aggressively snaps back up toward the average.
That's a perfect visualization.
But once it hits that average at $108, the momentum often stalls. It either has enough energy to snap the rubber band completely and break out higher, or the resistance is too strong and the price gets rejected and falls back down.
That rubber band analogy is excellent because it perfectly explains the tension we are seeing in the technical indicators right now. The MCD indicator, which is a tool that measures the momentum of a trend by comparing short-term and long-term averages, shows strong, undeniable bullish energy. People are actively buying the stock, pushing it higher.
Yeah.
But simultaneously, the RSI, the Relative Strength Index, is currently sitting at an elevated level of 79.
And for context, anything over 70 on the RSI means a stock is technically considered overbought. Explain the mechanics of the RSI. Why is 79 a warning sign?
The RSI measures the speed and magnitude of recent price changes. It evaluates how fast the rubber band is stretching. If it hits 79, it mathematically indicates that the buying pressure has been so intense and the price has run up so fast over a short period that it is statistically highly probable to experience a cool down, a profit-taking phase, or a short-term pullback before it can muster enough sustained energy to break through that 200-day moving average resistance.
So it's basically out of breath.
Exactly. It is out of breath.
And the social sentiment analysis in the report perfectly reflects this exact tension between hype and caution. The AI agents scraped Reddit, X, YouTube, and the financial blogs, and the overall social sentiment is roughly 54% positive around mid-April.
Pretty split.
Yeah. If you go on Reddit's Wall Street Bets or the major investing forums, the daily discussion is absolutely buzzing with streaming winner-takes-all narratives. Retail investors love the ad tier hype and the massive earnings beat. But if you scroll down, the veteran bears are in the comments loudly waving the valuation flag, screaming, "Guys, the PE ratio is 42. Please calm down. This is priced for perfection."
They're not wrong to be cautious.
So synthesizing all of this incredibly dense information, the massive free cash flow, the ad tier success, the high valuation, the lack of a margin of safety, and the technical resistance at the 200-day moving average, the AI multi-agent framework provides a final, definitive investment stance. And that stance is,
Watch. Not advocate. Not aggressively buy. Not avoid or short. Watch. The research team's highly synthesized commentary concludes that Netflix is undeniably a high-quality platform compounder. It has survived its turbulent youth and emerged with elite, bulletproof economics. But the current market valuation offers a razor-thin margin of safety. You are paying absolute top-dollar full retail price for a great company.
Okay, I have to challenge that conclusion because to a retail investor, the verdict of watch feels like a complete cop-out. Isn't watching just a fancy institutional way of saying, I don't know what it's going to do? What exactly are we explicitly watching FOR? If I'm sitting on the sidelines with my cash ready to deploy, what is the specific trigger that changes this from a watch to a buy?
It is absolutely not a cop-out. Watch is the active posture of disciplined, patient capital. A value investor makes their money by waiting for the market to make a mistake. The intelligence report outlines exactly what specific metrics to monitor over the next 1 to 4 quarters to find that mistake.
Okay, give me the list.
First, you watch the ad ARPU, the average revenue per user, specifically generated on the ad tier. If that ad revenue scales faster than expected and materially, dramatically lifts their overall profit margins beyond current projections, the intrinsic value of the company actually rises mathematically.
So if ads explode, the high price is justified.
Exactly. A rising intrinsic value would eventually justify buying the stock, even at these elevated 108 prices. Second, and more commonly, you watch for a broader macroeconomic market pullback. If inflation fears or geopolitical events drag the entire stock market down and Netflix gets unfairly punished in the sell-off, dropping the price closer to that $100 or even $95 technical support level, the risk-reward ratio instantly becomes much more favorable for a value investor.
You just get the same great company on sale.
Exactly. And third, you watch for industry consolidation. If a major, well-funded competitor like Paramount or Hulu starts to truly financially falter, miss their debt payments, or get absorbed in a fire sale, Netflix's competitive moat widens instantly, making their future cash flows much more secure. That is the disciplined execution of watching.
Okay, let's bring this all together. We have been on quite the journey with this company today. Netflix successfully survived its incredibly awkward, highly risky, debt-fueled adolescence. It won the initial brutal streaming wars by simply outspending every single legacy media company until the competition tapped out and started licensing their own shows back to Netflix.
They really won the war of attrition.
They did. It has completely transformed into an elite cash-generating machine with brilliant, highly effective news strategies in targeted advertising and massively scaled live global events like the World Baseball Classic. However, the premium price tag of $188 means the sophisticated stock market already knows all of this. The good news is completely baked into the current price, leaving traditional, disciplined value investors waiting patiently on the sidelines for a better entry point or a major market-driven dip.
It is the absolute classic dilemma of modern investing. Finding a truly great business that is currently trading at a good, but not exceptionally great price. The underlying fundamentals of the company have literally never been stronger, but the market is demanding absolute, flawless perfection over the next 5 years to justify paying the current multiple.
And as we wrap up this massive deep dive, I want to leave you, the listener, with a final provocative thought to mull over, something that builds on the deep value intelligence we just meticulously went through, but looks even further over the horizon into the unknown. We touched on it briefly during the risk section, but I want you to think deeply about the impending, unavoidable collision between massive streaming platforms and generative AI.
It's the big one.
If AI technology eventually makes creating blockbuster, visually stunning cinematic shows incredibly cheap and lightning fast, does that supercharge Netflix's profit margins to unthinkable levels, allowing them to completely bypass expensive Hollywood studios, fire the CGI houses, and generate infinite, hyper-personalized content entirely in-house for pennies on the dollar? Or does it completely destroy their massive financial moat? Because suddenly, anyone with a laptop in their garage can render a sci-fi epic that looks exactly like a $20 million episode of Stranger Things, bypassing the Netflix distribution platform entirely and going straight to the consumer.
It's wild to think about.
Will AI make Netflix the single most profitable entertainment monopoly on Earth, or will it render their massive scale entirely obsolete? It is the ultimate wild card that no spreadsheet can model.
It really is a profound existential question that absolutely no financial DCF model can accurately price in right now. The technology could be their ultimate final margin expander, permanently cementing their dominance, or it could be their ultimate fatal disruptor.
Before we go, to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you like to access wider topics including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
Thanks for listening, everyone.
So the next time you are sitting on that couch and you hit that red button on the remote and you hear that famous ta-dum, just remember, you aren't just firing up a movie to kill time. You are actively interacting with a heavily optimized, globally scaled, remarkably efficient cash-generating financial engine that has fundamentally rewired how the entire world values and pays for entertainment. Keep watching the screen for the plot twists, but keep a much closer eye on the balance sheet.